Hi class. So tonight we're going to go over how to journalize bonds issuing from a company that issues bonds and how to journalize that. So we're going to start out with reading here. It says Kale Company issued $350,000 of 8% 20-year bonds on January 1st, 2017 at face value. Interest is payable annually on January 1st. So we're going to prepare the journal entries to record the following events. So the first one we need to do is the issuance of the bonds. So to issue the bonds, we will debit cash and we will credit bonds payable. And since it's at face value, we're just going to do 350,000, which is the amount of the bonds payable. So we'll debit $350,000 to cash, so it'll increase our cash, and we will credit our bonds payable to show it in that account. All right, the next one we have is the accrual of interest on December 31st, 2017. So in order to journalize our accrual interest, we're going to debit our interest expense and we're going to credit interest payable. And we will do that. The way that we calculate that is it's going to be, we're going to do equals the sum, and then it will be our bond amount times our interest rate, which we see up there is 8%. And then since this is for a full year, we don't really need to do the month part, but if there were months, we would want to additionally do how many months per the year. So since this is for the entire year, that will just equal 1, so it won't make any difference. So we'll just put it at that. And so we will debit our interest expense for the $28,000 and we will credit our interest payable for the same amount. Our next one is the payment of interest on January 1st, 2018. So now we're saying we have the interest expense, we put it into interest payable. So now we're going to take it out of interest payable because now we have to pay it out because it's due annually. And we're going to credit cash because it's for paying it from our cash account. So it's just going to be the same amount since that's our annual amount. Okay, our next one is the redemption of the bonds at maturity, assuming interest for the last interest period has been paid and recorded. So this is 20 years later, we've had our bond and it's time to redeem it at its maturity. So it's not early or late or anything like that, just right at maturity time. And we've paid all of our interest into it, so we're ready to go. So now we're going to get rid of it out of our bonds payable account. And we are going to credit cash because we're going to pay, we're going to credit cash. So we're going to pay it out of that account for the full amount. $350,000. Now we don't need to add our interest or anything because we've been paying it every single year. So all that's still owed is the actual bond itself. So I hope that helps. If you have questions, let me know. Or if I did anything that didn't make sense or wasn't correct, please leave your questions below and I'll do my best to help you out. Thank you so much.